All right, so Regional REIT, you probably know them as RGL, just had, well, a pretty brutal 2025. But here's the thing. Instead of hiding from it, they've launched a really bold turnaround plan. So the big questions are, what exactly went wrong? How are they fixing it? And what's this massive bet they're making on the future of the office market? Let's break it down.
And hey, you don't have to take my word for it. The company's own CEO, Stephen Inglis, kicked off their latest earnings call with this very frank admission. He made it crystal clear. Headwinds like higher interest rates and a sluggish leasing market had a very real and very negative impact on their bottom line.
So what did this difficult year actually look like in cold, hard numbers? Well, two key things took a direct hit. Tenant occupancy dropped, and the dividend for 2026 was cut. For any investor, this immediately raises the million-dollar question. What's the plan to turn this ship around?
Okay, before we can get to the solution, we really need to understand the problem. And for RGL, 2025 wasn't just a bad year, it was kind of a perfect storm of market pressures and a few very specific, really painful hits. Let's dig in.
The first number that just jumps off the page is this one, 76%. That's their new occupancy rate, which, is the key measure of how many of their buildings are actually leased out. Now, any drop in occupancy is bad news, for sure. But what's fascinating here isn't just the number. It's the story behind why it dropped.
And here's the real kicker. This wasn't some slow bleed of dozens of small tenants leaving over time. Nope. According to the CEO, this massive drop was almost entirely caused by just 3 large, unexpected tenant departures. Think about that for a second. 3 tenants were responsible for over half of the portfolio's entire valuation decline. That's a major shock to the system.
Okay, so that's the problem. A sharp, sudden hit from losing a few key tenants. In response, management didn't just panic. They accelerated a very clear 3-part strategic plan. It's designed to stabilize the business and really position it for future growth.
So here they are, the 3 pillars of that plan. First, aggressively sell off the non-core, underperforming assets. Second, take that cash and reinvest it into upgrading their most promising properties. And third, use the proceeds to proactively manage and pay down their debt. It's simple, it's focused, and each step kind of feeds right into the next.
Let's start with Pillar 1, selling assets. The company put a number on it, and it's a big one. In 2025, they sold £51.6 million worth of properties. This wasn't just about hitting a target, they actually exceeded it, which shows a real commitment to this part of the strategy.
What's really smart here is what they're selling. They are zeroing in on vacant, underperforming properties. And why? Because empty buildings are just a drain on cash. You're still paying for upkeep, security, and taxes, what are known as void costs. So by selling them, RGL does 2 things at once. They raise cash to pay down over £50 million in debt, and they boost their net income by an estimated £2.1 million just by cutting those costs. It's a classic case of addition by subtraction.
So, what are they doing with all that cash they got from the sales? Well, that brings us right to Pillar 2. They're plowing it directly back into their best properties to capitalize on a huge trend we're seeing in the market, the flight to quality. And they are absolutely putting their money where their mouth is. In 2025, they spent £11.8 million on capital expenditures, or CapEx, which is just the business term for money spent upgrading their buildings. That's a huge jump from the year before, and it shows they're really stepping on the gas with this part of the plan. So, what does that £11.8 million actually get you? Well, the return on investment is pretty stunning. The average rent across their older properties is about £15.60 per square foot. But for the spaces they've refurbished, they're getting between £20 and £30 per square foot. That is a massive uplift, and it's all driven by creating the modern, energy-efficient spaces that today's tenants are really demanding.
And the CEO explains the why behind it perfectly. This isn't just about a fresh coat of paint. It's a direct response to what the market is screaming for. Companies today, they are demanding high-quality, grade-A office space with top-tier energy performance certificates, or EPCs. And that is the exact product RGL is now laser-focused on delivering.
So we've got the problem and the solution. But, executing a plan like this has consequences, especially in the short term. This part of the story is all about making those tough choices right now to secure a stronger future.
And the most visible pain point for investors is this number right here. The new dividend target for 2026 is 8 pence per share. That's down from 10 pence in 2025. Now, on the surface, a cut is never what investors want to see, but it's an absolutely critical piece of the puzzle.
And this right here is the crucial point. The company calls this decision prudent. And you might be asking why? Well, it's because instead of paying that cash out to shareholders today, they're reinvesting it directly into that big upgrade program we just talked about. It's a simple trade-off, isn't it? A smaller dividend check now to fund the investments that should generate much bigger, more stable profits tomorrow.
This table really sums up the entire turnaround story in just 3 lines. You can see the asset sales strengthening the balance sheet, the occupancy hit that really started this whole process, and the dividend cut that's funding the future. Each number tells a piece of this interconnected story of problem, plan, and trade-off.
And now for the final and maybe most interesting piece of the puzzle. Why go through all this pain? It's because RGL is making a big, calculated bet on a major shift that's happening in the UK regional office market.
I mean, this quote from the CEO is pretty stark. New construction starts are at a 15-year low. And yeah, while some older projects are still being finished up, the pipeline of future buildings is drying up, and it's drying up fast.
And this chart really visualizes what the CEO is talking about. You can just see it. The supply of new office space is about to fall off a cliff. After 2027, the pipeline of new buildings being delivered just shrinks dramatically. This is creating a potential shortage of high-quality office space in the very, very near future.
And this is where the entire strategy just locks into place. RGL is betting that as the supply of brand new buildings vanishes, the demand for the next best thing is going to explode. And what is that next best thing? It's high-quality, energy-efficient, beautifully refurbished Grade A space, the exact product they are creating. They are basically positioning themselves to be a key supplier in a market where demand is growing and supply is about to disappear.
So that leaves us with the final big question. Regional REIT has made its move. They've sold off the old, they've cut the dividend to reinvest, and they are all in on upgrading their portfolio. With a potential supply crunch looming on the horizon, the question is this bet on quality the right one? Is this the strategy that will allow them to not just survive, but actually thrive in the new office landscape? Well, only time will tell.